When finance professionals start murmuring about yield curve inversions, most people tune out. They assume it's just another dull economic phrase with no relevance to their everyday life. But here's what they fail to realize. Every time this signal appears, it's like watching a massive financial quake gather strength underground. And what's unfolding right now makes 1929 look like a small shake and 2008 feel like a rehearsal. The yield curve has forecast every major recession for half a century. Not some, not most, but every single one. And currently, it's flashing warnings strong enough to keep veteran Wall Street traders awake at night. But this moment is different, and not in the usual naive sense people mean when they utter those risky words. Today, the pressures building inside the financial system are more complicated, more intertwined, and more volatile than anything seen before. Most people believe they grasp what triggered 1929 and 2008. Stock market crash, bank failures, job losses. Simple narrative, right? Wrong. Those events weren't just market collapses. They were the predictable outcome of years of engineered finance, exploding debt, and a widespread misunderstanding of risk. And every warning sign that came before those disasters is glowing bright red today, intensified by forces that didn't exist in past decades. Let's begin with what a yield curve inversion actually represents, because if you don't grasp this, you're navigating the modern economy blind. Government bonds are supposed to work in a certain way. The longer you loan money to the government, the higher the interest you should earn. It's basic logic. If your money is locked up for 30 years rather than 2, you expect compensation for the additional risk and time. When short-term rates rise above long-term rates, that natural order turns upside down. It's like watching water run uphill. Something deep in the system is broken. This inversion happens when investors become so frightened of the near future that they accept lower returns on long-term debt simply for safety. They're essentially paying the government to store their cash because everything else looks more dangerous. It's mass fear wrapped in a technical signal. And whenever this fear reaches a tipping point, the economy breaks within roughly 18 months. In 1929, the curve inverted in early 1928. Investors were pouring money into stocks, convinced that good times would last forever. Sound familiar? The Federal Reserve was tightening policy, attempting to cool an overheated economy built on speculation and leverage. Banks were lending freely to anyone breathing, and average Americans were buying stocks on margin, believing they had found a guaranteed money machine. The inversion was the system's way of shouting that the setup was unsustainable. 18 months later, Black Tuesday hit, and everything unraveled. But here's what most history books skip. The 1929 collapse wasn't just triggered by the stock market. It stemmed from a tangled network of financial ties that no one fully understood until the damage was done. Banks financed speculators, who used that money to buy more shares, which pushed prices higher, convincing banks to lend even more. When the loop broke, it didn't fail in one spot, it snapped everywhere at once. The 2008 meltdown followed a hauntingly familiar script. The yield curve inverted in 2006, and once again, almost nobody cared. Home prices surged, banks bundled mortgages into complicated products, and people believed they'd discovered risk-free wealth. The inversion warned anyone paying attention that the structure was fragile. But profits were too enormous, bonuses too tempting, and the warning signs too technical for the public. When the housing bubble burst, it exposed the same interconnected chain of financial ties that wrecked the economy in 1929. Banks lent to homeowners who couldn't repay. Those loans were turned into securities and sold to other institutions. Those institutions used them as collateral for more borrowing. Once home values stopped climbing, the entire system imploded, taking down investment banks, insurers, and pension funds that most people didn't even know existed. Now we're watching the same story unfold again, but rewritten with technology, globalization, and monetary policy that older generations would have considered impossible. The yield curve inverted again in 2022, and the forces gathering today make past crises look straightforward. Look at the sheer scale of modern debt. In 1929, total U.S. debt was manageable relative to the economy. By 2008, it had ballooned, but it was still within historical norms. Today, we're surrounded by obligations so enormous they're impossible to fully comprehend. Government debt, corporate debt, student loans, credit cards, mortgages, the sums are so vast that they no longer feel real. But the size of the debt isn't the most frightening part. It's how quickly it moves and the complexity of the relationships it forms. In 1929, a bank failure in New York might take weeks to affect other cities. In 2008, digital trading spread panic around the globe in hours. Today, algorithmic trading, crypto markets, and derivatives that live only in code can unleash chain reactions at the speed of light. The Federal Reserve's responses to past crises have created problems far larger than the ones they aimed to fix. After 2008, they printed trillions and kept rates near zero for nearly 10 years. This wasn't a true fix. It was a delay tactic, inflating asset prices and encouraging even more borrowing. When debt can't be solved, government policy usually creates more debt and hopes for change later. But something did change. A decade of ultra-cheap money inflated bubbles people don't even recognize as bubbles. Housing prices in big cities detached completely from local wages. Stock valuations reached levels past generations would have called absurd. Corporations borrowed heavily for buybacks and mergers instead of meaningful investment. The entire system became dependent on cheap credit, and now that dependency is being tested. Today's inversion is different because today's economy is different. It's not just stock or housing speculation. It's speculation in every corner, fueled by debt structures that never existed before. Cryptocurrency markets, which didn't exist in 2008, now account for trillions in paper wealth built entirely on collective belief. Private equity firms have taken over hospitals, media outlets, and more using borrowed money, injecting vulnerabilities into sectors once considered stable. Meanwhile, central banks have exhausted the tools that helped them fight earlier crises. Rates were already near zero when the pandemic hit, so they printed even more and even dipped below zero in some regions. Government spending exploded to levels recently thought unimaginable. The ammunition used to fight past downturns is gone, and the threat approaching is bigger than anything before. The real danger is that most people believe these strategies worked. They think the Federal Reserve rescued the economy in 2008 and again in 2020. They don't realize those moments weren't victories. They were postponements. Every intervention deepened the underlying issues and added new ones. The yield curve inversion isn't just predicting a recession. It's signaling the moment when accumulated problems surpass the system's ability to hide them with more money printing and debt creation. The most frightening part of what's coming isn't the crash itself. It's what happens when the usual solutions fail. Every past crisis was softened, or at least delayed, by the same strategy. Lower interest rates, more government spending, and unlimited money printing until confidence returned. But that only works if you have room to act. Today, we're stuck in territory where the old playbook breaks down. Interest rates have been distorted for so long they no longer reflect true market forces. The price of money, which should behave like any commodity, has become a political instrument. Central banks convinced themselves they could manufacture prosperity by making borrowing cheap and saving pointless. The result is an economy that cannot function without continuous artificial support. Consider what this means for everyday people. Your savings account earns almost nothing because central banks prioritized debt growth over rewarding savers. Your home is far overpriced because cheap credit turned housing into an investment game instead of a necessity. Your employment is tied to companies kept alive by borrowing at artificially low rates, not by real profitability. This isn't sustainable, and the yield curve inversion is the market's way of stating the obvious. But unlike past inversions, this one is happening when most escape routes are blocked. Central banks can't meaningfully cut rates because they're already too low. Governments can't spend dramatically more because public debt is already extreme. The tools that worked in 1929 and 2008 were used up fighting smaller battles. Corporate America has spent the last decade and a half adapting to cheap borrowing instead of genuine business development. Buybacks replaced innovation. Financial tricks replaced real growth. Companies borrowed not to expand operations, but to inflate stock prices and reward executives. When credit becomes costly or unavailable, these businesses won't just stumble. They'll realize they've forgotten how to operate normally. The interconnectedness that made previous crashes severe has evolved into something far more intricate. In 1929, banks were linked through straightforward loans. In 2008, the links ran through mortgage-backed securities few understood. Today, the ties run through derivatives, crypto platforms, forex swaps, and automated trading networks faster than human reaction time. One failure in this system can trigger cascades through channels that didn't exist before. When a major crypto exchange collapses, it harms more than digital traders. It impacts pension funds holding crypto-based products, banks servicing crypto firms, and tech stocks reliant on blockchain hype. The shockwaves move through institutions that seem completely unrelated. International dynamics add even more instability, making the current moment uniquely dangerous. The dollar's global reserve status means U.S. monetary policy shapes every other economy. When the Fed prints money, it exports inflation to countries with no recourse. When it raises rates, it sparks currency crises in nations loaded with dollar-denominated debt. This interconnected world means that when the U.S. system finally cracks, it won't remain a U.S. disaster. Countries that borrowed in dollars will face unpayable debts when the dollar strengthens and their own currencies plunge. Trade systems relying on stable exchange rates will crumble. Supply chains delivering food, materials, and technology will strain and break. But perhaps the most dangerous factor is psychological. Earlier generations accepted that markets rise and fall, that cycles happen, and that downturns are part of growth. Modern investors have lived in an era where central banks intervene at every major decline. They've been conditioned to believe someone will always rescue them. This moral hazard has created reckless behavior unimaginable decades ago. Pension funds buy junk debt because safe bonds yield almost nothing. Retirees chase growth stocks because dividends have been crushed by policy. Students take on massive debt for degrees with little earning potential because they've been told education loans are always worth it. When the system finally breaks, these people won't just lose money. They'll lose faith in the institutions that guided their decisions. The belief that hard work, saving, and trust in the system leads to security will collapse. The political fallout from that realization may be worse than the financial fallout. What's approaching is more severe than 1929 or 2008 because it's the sum of all the errors made during those crises, amplified by technology and policies that removed natural limits on excess. The yield curve inversion isn't calling for a simple downturn. It's predicting the moment when decades of financial engineering collide with economic truth. The question isn't whether this crash will be bigger than the last ones. The question is whether the institutions and social frameworks holding society together can withstand it. History suggests they might not, and if they fail, the market crash will be the least of the damage. The warning signs aren't hidden in obscure charts or buried in technical documents. They're everywhere, glowing like neon signs in a storm, visible to anyone willing to look past the polished narratives designed to keep people calm and consuming. Corporate earnings padded with accounting tricks reminiscent of Enron, banks posting huge profits while quietly reserving billions for future loan losses they won't openly discuss. Government reports measuring everything except what truly affects families trying to make ends meet. Look at the labor market, supposedly the strongest part of today's economy. Unemployment appears low until you realize millions have stopped looking for work altogether. They're not counted as jobless because they've abandoned the search. Meanwhile, new jobs pay wages too low to afford housing in the cities where they're located. Workers are forced to choose between rent and food, transport and healthcare, daily survival and future security. The gig economy, praised as innovation, is really a sign of an economy incapable of providing stable employment. When full-time work with benefits disappears, people stitch together multiple gigs to survive. They're told it's flexibility, but in truth,
It's desperation dressed up as opportunity. These workers have no safety net, no predictability, and no route to building wealth. They're one missed bill away from eviction, one health issue away from financial ruin.
The yield curve doesn't fabricate warnings. It reflects reality. And right now, it's shouting that the stories we've been told about recovery and stability are illusions. This isn't panic, prophecy, or exaggeration. It's math, history, and human behavior converging into an unavoidable outcome. The only remaining question is whether you'll be among the millions blindsided when the illusions collapse, or among the few who recognize the signs and prepared for what's coming. History has already shown the pattern. The signals are everywhere. The decision is yours.